Thank you, Mark. Thank you, everybody. It's a good time to talk about the economy, right? Just a couple of things have happened over, the last couple of weeks, right? So, as we're thinking about everything that's happened, a lot of stuff has been in the news. A lot of stuff has been in the media. I'm sure you've all been reading, hearing, watching. But we sit at a very interesting time period because not a lot of it is reflected in the data yet. So as we put together the presentation for today, what we were thinking is, if we were a workers' compensation stakeholder, what would we want to know? And so hopefully as we go through the next 60 minutes, we'll be able to answer some of those questions as you're thinking about what is in store for the economy in 2025. So today we're going to go through 4 portions of the economy. We have growth, we have employment, we have inflation, and we have interest rates. And we're of course going to be looking at these through a workers' compensation lens. Starting off in the first section with growth. And I think the first question here is probably the one that is on the top of everyone's mind. Is the economy once again heading for a recession? Now, those of you who know me, I demand audience participation, so show of hands, who thinks we're heading for a recession? Who thinks everything's just fine, the economy's going to hold in? Who has no clue? Does anybody want to change their answer because they didn't know that there was a third option? Exactly. That's almost a perfect encapsulation of the next 60 minutes of the presentation. There's a lot that we don't know right now. Uncertainty is, of course, very, very high. So how will we answer that question? How will we know if the economy is going into a recession or already in one? We'll take a look at some of those data points. And then lastly, and I think most importantly here, what's going to happen to workers' compensation if we do head into a recession? So let's get started. Before we look forward, though, let's take a brief look backwards. And I know March of 2025 feels like ages ago, but just 2 months ago, the narrative broadly for the economy was that of U.S. economic exceptionalism. The economy is about 13% larger than it was coming out of the pandemic, even including the decline that we saw in 2020. Now, what do I mean by exceptionalism? What does that 13% mean? Well, to benchmark it for you, put some of our developed market peers. Canada, the closest economy to us, only about 8% higher over that same time period. Most of Europe around 5%, as well as Japan. And then poor Germany has been in and out of recession for the entirety of the post-COVID recovery period. You can really see how much the US economy has outperformed our developed market peers out there. Now, unfortunately, as I mentioned, some things have happened over the last couple of months, and this narrative has now been canceled. U.S. economic exceptionalism is no longer the broad narrative out there. Now the narrative is that of uncertainty and questions around what's going to be coming in the future. So if we think about what's going to be coming, we do have one data point that we just got a couple of weeks ago that we can look at, and that was first quarter GDP, in which case the economy declined in the first quarter for the first time since 2022. Now, is this a simple answer to the question I asked earlier? Is the economy already declining? Well, yes and no. There were a couple of really goofy things happening in the first quarter, and when we dig into the details, it should be very obvious that this is not what things are supposed to look like. First, I'll draw your attention to the large gray bar at the bottom. Net exports subtracted 5% from the economy in the first quarter. Now that was offset by personal consumption and investment up at the top, leaving us with a net decline of only 30 basis points. Now, net exports was pre-buying activity ahead of tariffs. We saw record levels of imports in February, and then we beat it for record levels of imports again in March. And that led to that decline. Now, just an accounting trick here, net exports subtract from the economy overall because they're offset by consumption or investment later on down the road. Now, private investment, you'll notice the light blue bar up at the top, surged in the first quarter. Now, I would love to be able to get up here and say that this is companies building new factories and investing in equipment, but actually that's just inventories. All of those imports that came in through the ports, they needed somewhere to go. And businesses had to store them in inventories before they'll ultimately sell them later on down the road. Now, the last thing to take away here is the solid blue bar at the bottom, personal consumption expenditure. Now, it's the largest portion of the economy, makes up 70% of GDP. And you'll notice that while we did see consumption grow in the first quarter, it grew at a much slower pace than what we had seen in prior quarters. So is that the signal to be looking at for the economy? Well, once again here, no. The answer is not. If we think back to what happened in the first quarter, I'm from the Northeast. Is anybody else from the Northeast? You remember how cold this winter was? Long, cold, terrible weather. Turns out much of the country actually experienced a long, cold, terrible winter as well. And that hampered a lot of economic activity that we would have otherwise had. Additionally, we had the distortions from the LA wildfires, a big impact to economic activity in the first quarter. Now, as we think about what coming quarters would look like, I would have said we'd see some reversal of these distortions. But now, given what we just learned yesterday with the 90-day reprieve on tariffs from China, we'll talk about that in a little bit more detail later on, we may see these distortions continue in further quarters. With that 90-day reprieve now, companies may again rush to bring imports in ahead of the end of the year. You know, it's May. It's the perfect time to start thinking about Christmas, right? All of those products usually come into the country in, late August, early September. But with this tariff reprieve, some companies may make the decision that they want to try to bring in product earlier to catch the lower tariff rate rather than what could potentially be coming in the future. Again, uncertainty can drive economic decisions. So what if we look at the economy differently? We saw these large distortions that we had in the first quarter. So instead of looking at real gross domestic product, that's the sum of consumption, investment, government spending, and net exports, what if we take those net exports out? As I mentioned, they subtracted 5 percentage points from the economy in the first quarter. Well, on a year-over-year basis, you can see gross domestic purchases in real terms fared differently than the overall economy. Instead of seeing a deceleration year-over-year growth, gross domestic purchases accelerated because we took that large decline out. Now, there's also been some noise made about government spending. So what if instead of taking out net exports, we take out government instead? Now you have real private domestic goods and services. And as you can see here, essentially no difference whatsoever from GDP overall. Government did not contribute meaningfully to the trend that we've seen in the economy over the last year or so. But lastly, what if we take both of them out and instead just look at the sum of consumer spending and business investment? These two categories, the most important areas of the economy, represent about 85% of GDP, and that leaves us with real final sales to private domestic purchasers. Now that's a mouthful, but everybody needs to remember it. It will be on the test later. That is the most important measure to look at for the economy. Consumer spending and business investment is the backbone of the economy, and where this metric goes, the rest of the economy will follow as well. Now, looking at this short time series that we have, you'll notice that there are some bumps and deviations in any individual quarters, but over time, all 4 of these measures trend together. And over time, they will all converge back to real final sales to private domestic purchasers. So we need to think about this when we're assessing the economy as we go forward, especially because, as I mentioned, there's likely to be some pretty significant distortions further on down the line. Now let's pivot to 2025. I'm sure that's what you all are here for, and you all want to know about what's coming. So over the last couple of years, we've seen the economy growing between 2.5% and 3%, very strong rates coming out of the pandemic. Now, at the beginning of this year, economists were projecting that the economy in 2025 would grow between 2 and 2.5%, a little bit of a step down from previous years, but very strong growth in the context of the last 20 or so years of history. But at the end of March, things started to change. And I'm sure you've all recognized the headlines, the media, et cetera. And forecasts from economists started to decline, now reading just 1.35% for this year, down from 2.2%. Now, this audience, I think, is made up of people with an above-average acumen for statistics. So you'll all recognize that when you have a survey sample of about 80 individuals, how much it actually takes to move the median estimate from 2.2 down to 1.35. A lot of opinions have changed. But there's one very important opinion that I want to call out, and that is of the Federal Reserve, arguably the most important forecast out there. Now, if we take a look at where the Fed was back in December of 2018, they were thinking that the economy in 2025 would grow at 2.1%, the unemployment rate would be 4.3%, and that core inflation would be at 2.5%. Now, the latest forecast that we have from the Fed, and check the date here, March 19th, was for a decline in growth to 1.7%, an increase in unemployment to 4.4%, and an increase in core inflation to 2.8%. Now call out that date. Remember, this is before the April 2nd announcement of reciprocal tariffs on most countries that we trade with. Now I'm going to call out those last 2 points again for everybody: an increase in their forecast for the unemployment rate and an increase in their forecast for core inflation. Those of you that remember back to the late 70s and early 80s will be thinking to yourself, those are two things that we don't typically like going up at the same time. Yes, I'm referencing stagflation, something that has once again come into our lexicon as a key risk to be watching out there. Now, we did have a meeting from the Fed last week, but they did not provide an update to forecast. The next round of forecast from the Fed is going to be coming at their June 18th meeting. So it'll be very interesting to see if their opinions have changed. Now, in the press conference after their meeting last week, though, Chair Powell did call out that they see the risk to higher unemployment has increased, and the risk to higher core inflation has increased over where they were in March. So again, two things that we typically don't like to see as economists. So obviously with this backdrop, the question that's on everybody's mind is, what is the probability of recession? So taking a look at survey probabilities from economists back in January, you'll notice that the probability was a little bit elevated over where we would normally be in any given year. Recessions typically happen every 8 or 9 years on average, so about a 15% probability makes sense. Now, I also want to call out the diversity of opinions here. On the far left, we have our most optimistic forecasters for the economy, predicting basically a 0% chance of a recession. And on the far right, we have our most pessimistic, even back in January, over a 50% probability. Now let's fast forward to April. A lot has changed. The average now is almost 50%, basically a toss-up as to whether the economy will experience a recession in 2025. Now there are a couple of notable changes here. Only 2 of the surveyed economists did not increase their probability over that time period. One of them is, again, on the far left. It's our most optimistic forecaster out there, still believing that there is a 0% probability of recession. I want to live in that forecaster's world. But also, you may notice the third dot from the right, lowering their probability of recession from 55% down to 50%. And you may not think that that's significant, but I call that out because it's a perfect encapsulation of the environment that we're in right now. If you don't know, why not just pin it at 50-50 as a coin flip? So what can we look at to think about if a recession is going to be coming? And now there's a multitude of metrics that I could show you here. We could look at port activity and container shipments coming out of China heading into the West Coast. We could look at purchasing managers' surveys and forecasts. But really, there's one key aspect of the economy that we need to follow. And I'm having a little bit of deja vu now. Just a year ago, I was on this very stage talking to this group about consumer confidence. And at that time, the story last year was of the vibe session. Does everybody remember that talk? That was a fun little talk. And now here we are again a year later, and the story is almost unchanged. We're once again at Great Recession lows of consumer confidence. We had an improvement in confidence into the end of the year. We thought the vibe session was ending. Turns out we couldn't have been more wrong. Now, when we think about the impact to the economy overall, there has been a discrepancy between what consumers have been thinking and what consumers have actually been doing. Now, we have a pretty tight relationship over the longer history between consumer confidence and growth in consumer spending. This has been a good indicator to see where consumers are thinking and how they're going to be driving the economy overall. But you'll notice coming out of the pandemic, there has been a large dislocation, which has just once again gotten larger. Consumers have been pretty dour about their opinions of the economy, while they've still continued to spend money like it's going out of style. Now, we laugh, but that's actually a great thing. If consumers continue to spend money like it's going out of style, we don't even have to ask the question. The economy is going to be just fine. We probably won't see a recession, rise in the unemployment rate, and everything will be great. But if we zoom in on that time period, you'll notice that things have only gotten worse, with consumer sentiment now back at the 2022 lows that we experienced at the peak of inflation, and a lot of questions have been caused out there as to whether the consumer can continue to spend through what seems like the fourth, fifth, sixth storm that they've weathered since COVID. Now, things are a little bit different than they were back in 2022. We don't have the pandemic-related stimulus. We don't have the rise in credit card debt. We don't have the excess savings that were driving spending back then. But if consumers continue to find a way to drive the economy, then things will likely turn out okay. So this is really what we want to be watching to cut through a lot of the noise out there around some of these indicators that really aren't telling us where things are going to be going. Now let's take a step forward and say, what if? What if the economy were to go into a recession? What could that look like? Now here we have a very long history going back to the end of World War II, and as you can see, we've had quite a few recessions since then. Now every recession is different. One of my colleagues says they're like snowflakes, and that's very true. The economic circumstances are different, the impact of the economy is different, what we see in the data is very different, but there are some generalizations that we can make. If we look back prior to 1980, you'll recognize that recessions happen more frequently, on average every about 5 or 6 years, compared to after 1980, where they have become less frequent, instead happening every 9 or 10 years instead. Additionally, if we look at the impact to the economy, we've had recessions that have been quite severe, most notably the last 2 recessions that we experienced. COVID actually being the most severe economic recession since the early 20s and the Great Depression. Then we've also had some mild recessions. And you'll notice on a year-over-year basis, in 2001, the economy actually didn't even decline, experiencing 2 small quarters of decline offset by 2 quarters of growth during that year. Now, let's think about what recessions do to workers' compensation. And we'll start with the premium picture. Now, as much as I would love to have data going back to 1947 on all aspects of workers' comp, I want to thank my team for putting together as much of a history as we have here to be able to go through. And this is a good look because we have, as I mentioned, 2 deep recessions as well as 2 mild recessions that we can look at. First, starting on the left-hand side of the page, we have the 1991 recession and the 2001 recession, both very mild. And as you'll notice, there was really no material impact to the premium equation going through. Premium growth remained relatively flat heading through the 1990 recession and continued its increase during and through the 2001 recession. But 2008 and COVID were a little bit of a different story. We saw that we had an acceleration in the decline in premium into the great financial crisis before balancing out of and then returning to growth again as the economy started to recover. Additionally, with COVID, we took a step down in premium for the 2 years during and after COVID before the economy added jobs back and we saw the recovery on the other side. Now next, let's look at the frequency picture and see if we can discern any trends here. And the story here is similar. Looking at the mild recessions on the left-hand side, in both instances, very little discernible impact on the trend in frequency from either of these recessions, continuing to see a decline into and out of both of these recessions. But again, looking at the great financial crisis and COVID, you'll notice very, very clearly that something changed after the recession. In both of those instances, we saw an increase in frequency coming out of those recessions. Now that might not make sense right away, but if you think about it, when we go into a recession and employment declines, it's typically not your worst, least productive, most likely to have an injury workers that are retained. It's usually your best, most productive, safest workers that are retained. So frequency improvements during a recession can happen. Then coming out of the recession, when the economy starts to add jobs back, now we have workers that are of lower tenure in positions. Maybe they switched industries. Maybe there was some skills atrophy in the time that they were outside of work. And we can see that frequency increased in those years prior, before then returning to its normal declining trend that we've seen over the longer period of time. Now, lastly, let's look at the severity picture. And here it's a pretty simple story. No discernible impact from the economy, both in large or small recessions on the severity trend. Medical severity is much more impacted by external factors from the economy, things like regulatory changes or things that are going on in the healthcare system at that time. So let me summarize these charts for you in a pretty simplistic way that I think everybody probably already knows. If we're going to have a recession, let's have a short, mild one, right? Let's not have a long, deep one, as the impacts to workers' compensation can be much larger during those longer or deeper recessions that we can see. Summing up this first section, economic uncertainty has risen and the probability of a recession is up. But the consumer is key. Where the consumer goes, the economy is going to follow as well. If the consumer is able to continue to hold spending patterns that we've seen over the last couple of years, all of this worry should dissipate over time, and we can see the economy continue to grow as we go forward. And lastly, workers' compensation behaves differently in different types of recessions. So if we are going to experience economic turmoil, we're all going to be hoping that it's going to be a short, mild recession rather than something longer or deeper where we would have larger impacts to workers' comp. Now let's transition into the second section of the presentation, employment, arguably the most important segment of the economy for workers' comp because obviously we insure working lives, right? So is the labor market flashing any warning signs for us? And here I'll give you the answer. I just wanted to make sure you were awake earlier. Here the answer is no. But that doesn't actually tell us that much because the labor market is a lagging indicator for the overall economy. Typically, we don't see big moves in the labor market until the economy is already in a recession, and then we'll see the large declines in employment. But are there any other useful indicators we can watch? And my leading question, of course, the answer is yes, and we'll go through them here. And lastly, is a recession the only risk to workers' compensation? There's been a lot of attention on this risk of will we, won't we have a recession, but there are some other things impacting the labor market that we want to keep an eye on as well. So again, we'll start by looking back before we look forward in where we've come from. And the trend in employment is that growth has become much more volatile. Starting back at the beginning of 2024, the economy was adding roughly 180,000 jobs a month on average, a very solid rate of growth seen in the labor market. And then in the summer of last year, we had a little incident we called the summer slowdown, where unexpectedly for 3 months, we saw the pace of employment gains meaningfully slow, down below 100,000 per month. Now, those of you that have been following our research closely will know that we called this out as a reason to become a little bit more concerned about the economy, even before all this, tariff stuff happened. Then at the end of the year, we saw a strong recovery in the labor market, averaging over 200,000 jobs per month, even with October. You'll notice we had quite a weak October, but that was the double hurricane month where we saw significant impacts to much of the southeast region of the country and disrupted some of the jobs there as well. Now into 2025 to start the year, it has been relatively solid, averaging just shy of 150,000 jobs per month. And as Donna mentioned earlier, really no signs yet that we're seeing meaningful stresses in the labor market overall. But again, I want to reiterate the labor market is a lagging indicator. And if we look back prior to the 2 recessions that we had excluding COVID, you'll notice that we saw a pretty similar trend in the period before, where we saw a step down in the pace of employment gains, as well as an increase in volatility monthly. In both of those periods, we even had several months where employment declined well before the recession. Now, there's 2 takeaways from that. One, a month of declining employment is not necessarily the indicator that we are in recession. And 2, again, once we are already in the recession, that's where you'll see the noticeable trend in decline in employment. So not quite as helpful of an indicator as we're trying to assess overall economic health. But employment is a very important indicator when we're trying to assess the health of workers' compensation. So let's take a look at that picture a little bit more deeply. You'll remember this slide from earlier in Donna's presentation with the payroll picture. Again, wage growth quite strong across industries, and employment growth, while it has slowed down, has also become more concentrated amongst a fewer number of industries. Now let's expand this picture to include payroll as well, and you'll see a similar trend. Payroll growth has been more concentrated amongst a smaller number of industries. So if you've been looking at your book internally and saying, I want to grow broadly with the economy, if you haven't been aggressively writing policies in areas like construction, like healthcare, you may not have been able to take advantage of this payroll growth as you would if you were just growing in all industries along with the economy. Now the picture in 2025 through the first 4 months of the year is quite similar. Roughly similar pace of employment growth if we annualize it out. And again, the story here is the same, concentration amongst a smaller number of industries. Wage growth strong pretty much across the board with a couple of key standouts, and that's driving, again, payroll growth that looks like it is set for another year to be above 5%. Again, let's all cross our fingers and say if the economy continues through the rest of the year like it has through the first 4 months. So let's take a longer look at the payroll equation again here and think about the impact from recessions. And again, I'm just reiterating a point that Donna made earlier. When we think about payroll growth, it actually typically does not decline unless we have a longer or deeper recession. Wages through recessions typically slow down, but don't go negative, 2009 being the one exception where we actually saw wage growth decline. Now, that was a very unique circumstance where, because of the economic damage experienced, workers in that time period were more happy to even have a job, much less try to get paid more during that time, a very unique experience. So as we think about where we are in 2024 and in the first couple of months of 2025, wages making up about 80% of that payroll picture, how sustainable is that wage trend as we think about what's to come? If we break down wages into its core components, we have average hourly earnings, that's the hourly rate that workers are earning on that work, and we have the average number of hours that they're working per week. And there's a couple of key things to notice. Coming out of the pandemic, the trend in average hourly earnings has come down, but has settled in at a very elevated level. We have hourly earnings growth that is running right around 4%, and as you'll notice going back through history, that's a rate that we haven't really seen much over the last 30 years, a very elevated rate of wages growing forward. Now, on weekly hours here, this is one of the indicators that we can look at for the economy that is a little bit of a leading indicator out there. If we think about the order of operations that a company will go through when they're thinking about how to respond to economic uncertainty or economic weakness, the first thing that they're going to do is either slow down hiring or stop hiring. We've started to see that already, slow down in hiring. The second that they'll do is they'll cut back hours worked. Now, we've seen hours worked come down, but really that's a recovery from the overworked levels that we had coming out of the pandemic. And now average weekly hours are back in line with where we were prior to the pandemic. So not a big concern there yet. And then lastly, after cutting back hiring and cutting back hours worked, companies will finally resort to layoffs if they still need to correct their cost structures. So a good sign there. Now, next I want to transition to a bigger picture question for the labor market. And before I get into that, I want to give you some numbers, some data. The Congressional Budget Office in 2024, that's the nonpartisan scorekeepers of Congress, they estimated that deaths would exceed births in the US starting in 2040. So absence any immigration, the population in the US would start declining in 2040. Now in 2025, earlier this year, they updated that analysis, and that deaths would exceed births starting in 2033. I'm going to let that set in. Absent immigration, we have 8 more years of population growth left in this country. And that highlights a key point when we think not only about the health of the labor market coming, but also for workers' compensation. As we know, labor supply can have deep impacts on our industry. So foreign-born workers, they make up a small portion of the labor force overall, about 15% back in 2009, but that has been growing, and now they represent about 20% of the labor market in 2024. Now that might not seem like a lot, but let's instead look at the cumulative growth in the labor market that we've experienced over this time. Since 2009, foreign-born workers have made up over half of the labor force growth that we've experienced. I want to say that again for emphasis. Over half of labor force growth has come from foreign-born workers. Now, as we think about labor supply, the economy loves a large supply of labor. In order to continue to grow the economy the way that we all are used to and that we like, we need to continue to grow the labor market. We need bodies that can be put in jobs to produce goods and services for the economy overall. Now, part of the reason behind this split has been participation. When we think about foreign-born workers, they typically participate in the labor market at a much higher rate than we see for native-born workers. Over time, a higher rate for foreign-born workers, but also notice coming out of the pandemic. Participation recovered for foreign-born workers much more quickly. In fact, in 2022, we already saw full recovery in the participation rate amongst foreign-born workers as compared to native-born. And now in 2024, participation amongst this class of workers is higher than it was prior to the pandemic. Now, just a reminder for everybody, these participation numbers are not adjusted for age. So when we think about the native-born population, much of that depressed level is from retirements, as we think about the overall demographic makeup of our labor force. Now, foreign-born workers not only important for the economy, but also important for workers' compensation. If we think about where foreign-born workers typically are within the labor force. Now, on the x-axis here, we have the share of foreign-born workers in a specific occupation, and on the y-axis, we have BLS frequency. That's injuries per 10,000 workers in those occupations as well. And you'll notice very clearly here that foreign-born workers are much more likely to be in more hazardous jobs. If we think about what's going on from a labor force growth perspective, any reduction in labor supply or tightening of the labor market in these high hazard industries is a flag that we want to throw up to think about what could be coming for frequency trends. We don't like a tight labor supply for frequency, and we don't like a non-available labor supply to fill those open positions. If we think about a lack of labor for going into those positions, that next marginal worker that's hired, maybe they don't have as much skill or experience. Maybe they need more training. Maybe companies are lowering their standards to get workers into those jobs. Now, we're not calling out specifically the frequency amongst foreign-born workers as compared to native-born workers, but just that foreign-born workers more naturally take up a larger share of these higher hazard industries. So we need to keep an eye on the available supply of labor for these industries as compared to our office-type sectors with much lower injury frequency. So let's sum up the labor market. Labor market indicators lag the broader economy, so there's not much that we can take away yet from the solid labor market experience that we've had in the beginning of the year. If the economy is heading down a more nefarious path, we'll see a deterioration in the labor market later than we would in other indicators. But there are some important things to still watch. As we think about the leading indicators within the labor market, we haven't seen any warning signs just yet either. And lastly, when we think about not only the near-term risks to workers' compensation from a possible recession, we also want to keep an eye on the longer-term risks, thinking about the demographic makeup of the labor force, as well as the potential available supply of workers that we might have 5 or so years down the line. Now let's move into our next section here, inflation. And as I'm sure you're all aware, there's a lot to talk about in this section. Oh, I hope you weren't expecting more bullets to come up there. There's really only one thing to talk about in this section, as I'm sure you're all aware. So let's dive into it. The largest tariff increase in modern history, with an asterisk. And I could actually even eliminate the word modern, because take a look at the x-axis. We are going back to the 1850s on this chart, because that is how far back we had to go. Now, I'm going to have to stop myself here for a second because some things happened over the weekend, right? We got a 90-day truce with China, and I want to specifically emphasize it as a 90-day truce because no deal was agreed, no deal was signed, but we do have a reduction in tariffs on both sides for 90 days to allow these economies to negotiate. So the pre-substitution effective rate that you see up here is no longer 28%. With the new roughly 35% tariff rate that we're going to have on China, that's the base 10% rate, the 20% tariffs that were put on earlier this year in February, plus the existing tariffs from the first Trump administration back in 2018, nets out to an effective rate of about 35% on imports coming in from China. The pre-substitution effective rate now has been lowered to about 18%. So significant drop from where we were as of a couple of weeks ago. I also want to mention that this includes the pending reciprocal tariffs that, again, were not eliminated. They were just delayed for 90 days. Those tariffs are coming in early July, so we need to keep an eye out for that. Now, the announcement over this weekend, though, was good news. when we think about what it could potentially mean for the economy overall. Because a 145% tariff rate on China is effectively an embargo. Not many goods are economically viable to be imported at a price that is essentially going to triple their cost before it hits a shelf. Now at 35%, things are a little bit easier, where prices may have to go up on some of these goods, but they will still be viable to bring in. And this has alleviated some of the fears that had been out there in the media around empty shelves coming up as early as this summer. Now again, I just want to stress that even though things have improved, that pre-substitution effective tariff rate of 18%, and then if we think about the substitution effects either from purchasing goods from different countries or purchasing different types of goods that may not be affected by tariffs, some of the currency offsets that we could see, the post-effective rate is about 16%, so not much difference. Really highlights the importance of China as a major partner for us in the economy. That 16% rate is still 8 times higher than the effective tariff rate that we had at the end of last year. So even though we've seen a significant reduction in tariffs over the weekend because of these deals, not just with China, but we also had a framework of a deal for the UK as well, the effective tariff rate is still going up 8-fold. And that's going to have implications for the economy overall. Now, thinking about what tariffs do, we have well-established economic principles that tell us that. So here we are about 35 minutes into the presentation, and I'm finally going to tell you the why. The why I went through all of those at the beginning. Why are recession probabilities elevated? Why have fears of the economy risen? And those economic principles tell us that when you raise a consumption tax, which tariffs are effectively a consumption tax on imports, the outcome is higher prices and lower quantity. And that lower quantity is the concern. If we have fewer goods that are being purchased because of the higher tax rate, that is either slower economic growth or potentially lower economic growth, a decline in the economy overall. Now, tariffs are incredibly complicated, and the global economy is even more complicated. So I want to take you through a couple of examples. Think about a good that you purchase on your own, a very simple example. So everybody goes out to Alibaba or Temu or Shein, and you purchase a product from China. You as the consumer there will just pay the tariff rate when that product hits the border, effectively an extra tax that's going to be put on it on top of your sales tax that you'll pay. Similar if you go to your favorite big box store and you walk up to the shelf and you pick up a product off that shelf. Very likely that product that you picked up was produced in another country, packaged in another country, and the end product was shipped in. The retailer that purchased that product to put on the shelf, they will be on the hook for that tariff rate, that tax. Now they'll have two choices of what to do. They can either raise their prices on the final product, or they can keep the price the same and they can eat the tariff tax themselves, in which case they would have higher cost of goods sold and lower profitability. In most instances, you're going to end up somewhere in the middle on that front, depending on those types of goods. But things get a little bit more complicated than that in other areas. So let's think about a different type of product. You and your friends go to your local pizza shop. Now, how in the world could that be impacted by tariffs, right? You're going to a local pizza parlor, it's locally made ingredients, it's cooked by your local pizza. How could tariffs impact you there? Well, like I said, the global economy has become quite complicated. Thinking about the pizza cutter, which was likely imported. The oven that cooks the pizza could have been imported or have imported parts that go into it when it needs to be repaired. And then think even all the way back to the beginning of the supply chain. The wheat that needs to be grown, the tomatoes for the sauce, could have imported fertilizers that go on the fields to grow them. The tractors, combines, trucks that transport those crops could all be made with imported parts and could have imported fuels going into them when we think about diesel fuel. The packaging that those parts go into before they ultimately make it to the end store can be imported and foreign made. And now all of a sudden, your pizza is impacted by tariffs. Now, when we think about the first example, it's quite simple. When the effective tax rate goes on, it's a one-time increase in the price because the tariff rate is steady after that. But for the pizza example, it's much more complicated because each segment of the supply chain that could be impacted is going to be impacted at a different time and at a different rate. And each time your local pizza shop experiences higher costs from these products coming in, they again have that same decision, to either accept lower profits or to raise prices. So hopefully that gives you an explanation of how complicated our lives have become and how these tariffs can have unintended consequences in areas of the economy that you might not have even thought. And when we're thinking about the question of, do tariffs cause inflation, the answer is both yes and no. And that's because we have to be very pedantic about the definition of inflation. Remember, inflation is the rate of change of prices over time, not just the overall level of price. And we have the example here on the slide for you. On the left is the rate of inflation, which is actually about back to where it was pre-pandemic. That's great news, right? Is everybody excited? No, nobody's excited, because on the right you have prices where everything is about 25% more expensive than it was prior to the pandemic. And this is key, because that one-time increase in prices that we'll see on some of those products will not cause inflation. Prices will go up temporarily, and then after 12 months, the rate of inflation will go back to normal, because that's just a one-time increase. But when we think about the pizza example, that maker of the pizza has to make that decision every single time a part in their supply chain comes under higher costs. And so you can see multiple increases to the price of that pizza over time, which is exactly the definition of inflation. And that's the problem, and why the debate has been so fierce around this topic. Does it cause inflation? Does it not cause inflation? Well, at the end of the day, let's not think about inflation. What tariffs cause for the economy is higher prices. And prices are something that everybody has been very concerned about. So let's pivot from the economy now to workers' comp. What does this mean for us? Well, both the rate of inflation and prices in workers' compensation have been very different than the overall economy over the last couple of years. The rate of price increases, as measured by our WCWMI, are again right back to about where they were pre-COVID, running at about 2% per year, after growing at about 3% last year. And prices are up about 13% from 2019. That's a rate of about 2.5% per year, in stark contrast to what we experienced in the overall economy. Now, before we dive into the details of workers' comp, I want to take one step back and let's think a little bit more broadly about the property and casualty industry. Does anybody have a friend in personal lines? You should laugh, because they're going to have a fun time again, maybe. Thinking about vehicles, this is one of the, I think, most openly talked about aspects of tariffs coming through. And we have the pandemic experience here for some benchmarking. We're likely not going to see as much of a disruption as what we saw during the pandemic, but analysts out there have been estimating that the price of a new vehicle could rise anywhere from a few $1,000s to over $10,000 per car, depending on the make, model, and country of origin. Now, new vehicle prices have settled in along with overall inflation in the economy, but if prices for new vehicles go up, as we all know, used vehicles are typically just a depreciation factor off of a new vehicle. Higher prices for new vehicles can raise prices for used vehicles as well, so we'll have to see how this ultimately plays through. And in fact, here we did get a data point just a week or so ago from an automotive analyst that saw wholesale prices for used cars in April started to rise. Now, we'll have to continue to watch to see if that's the beginning of a trend. One data point obviously does not make a trend, but a word of caution out there as we think about our friends over in personal lines. Let's pivot to property, because this has always been a fun one as well. Notice the scale. We kept it here similar for you so you can benchmark. Off the charts twice. Lumber prices increased 275% year over year, twice coming out of the pandemic. Large supply chain disruptions coming through before largely settling in line with overall inflation over the last couple of months. Now, lumber is a fun one because this is an exchange-traded commodity, so we have futures prices that we can look at to see if any hedging activity is going on. And this has been a fun one to watch because after the tariff announcements, we first saw a price increase, as you would expect, thinking higher prices for softwood lumber imports coming in from Canada. But then prices started to decline, and that caused economists to start scratching their heads. Well, as fears of recession rose and peaked, worries about whether the housing market would go into even further struggle started to dominate pricing here. So lumber's playing this tug of war between potentially higher prices from imported lumber from Canada and potentially lower prices if demand for housing activity would decline in any economic weakness. So that's been a fun one to watch. But now let's look at workers' compensation. And while we were first going to talk about drugs, something happened yesterday that again made this story a little bit more complicated. So let's skip over this one first and come back to it. Let's talk about medical equipment and supplies. This is one area that is going to be directly impacted in workers' compensation by tariffs. Medical equipment and supplies do have a large amount that is imported from other countries, but I want to call out here again, we left the axes the same so you can just see the difference in experience that we've seen in this aspect of medical prices compared to what we've seen in inflation in the broader economy. Prices for medical equipment and supplies actually declined into and out of the pandemic before recovering and have now settled in about 7 or 8% higher than they were back in 2020. That's a rate of growth of about 1% per year. Very, very moderate compared to what we've seen in other areas. Now, let's go back to drugs. This is another area that is going to be directly impacted by tariffs, not just in the reciprocal tariffs on foreign countries that produce pharmaceuticals, but also the administration has called out specifically additional 25% tariffs that the USTR right now is investigating on pharmaceuticals as well. But yesterday, the president signed an executive order potentially linking drug prices to the foreign price. Now that has thrown this entire equation into a mess because now instead of thinking about higher drug prices from tariffs, we might actually be thinking about lower drug prices from pinning Medicare drug prices to foreign rates, which, as I'm sure everybody here is aware, foreign drug prices typically a lot lower than US drug prices. So this conversation has gotten even more complicated now. But let's try to bring it back and think about what this means overall for workers' compensation. And first, let's take a look at the breakdown of medical costs that we have in workers' comp. So this will look a little bit different from the view that Donna gave you earlier this morning as we're looking at service year for 2023. We don't have the full data for 2024 yet. She was giving you the early look this morning, but largely dominated by physician services as well as facilities with hospital inpatient and outpatient. Now, in orange here, we have drugs and medical supplies. These are the two categories directly impacted by tariffs, about 15% of overall medical costs in workers' comp. Now, the areas in blue, while they are medical services and are not directly impacted by tariffs, they may have some indirect impact over time as we think about any supplies or equipment within physicians or hospital offices that may need to be repaired or replaced at a higher cost in the future, and that could bleed over into the overall cost of service somewhere down the line. Now let's bring the full picture for you, thinking about our workers' compensation weighted medical price index. You'll notice on the far right-hand side in 2025, the pace of price increases has been relatively moderate, about 2% through the first quarter, and that compares to about 3% for 2024. Now, I also want to point out the categories in orange again. Contributions from drugs and from durable medical equipment and supplies, not large contributors to the price pressures that we've been seeing in early 2025. Largely price pressures being dominated by physicians and hospital services. So as we think about what the potential impacts from tariffs could be, let me put a couple of scenarios out there for you. Now, a worst case outcome, and I don't think this is very likely, but let's think about the hypothetical of a 20% increase across the board on all drugs and all durable medical equipment. That would take our workers' compensation weighted medical price index from 2% in the first quarter up to about 5% per year, just to give you a benchmark. Now thinking about more realistic scenario, let's go instead 5% increase across the board on all drugs and durable medical equipment, and let's also put some spillover into physicians and facilities costs as well. Now we're thinking 2% up to about 3.5%. And that's about the pace of price increases that we were seeing back in the beginning of 2024. Then we can throw in the curveball that we got yesterday, and maybe now we have a 5% increase in durable medical equipment, but a 5% decrease in drug prices. We could see these offset, and we could see medical price trends remain largely intact from where they are today. So this is going to be one that's going to continue to be fun to watch, and as Mark mentioned earlier, luckily we now have our medical inflation insights that we publish quarterly to keep the industry apprised of developments that we're seeing in medical prices broadly in the economy. let's wrap up inflation. Whether it's the word or not, prices are going to be going up as a result of tariffs. We have a history of well-documented economic principles that tell us this, and in fact, even some of the largest proponents of these policies concede that these policies are likely to see prices going up across a large swath of goods in the economy. Workers' compensation is likely to be directly impacted from pharmaceuticals and durable medical equipment, and then also indirectly impacted in all other services. And lastly, and the key takeaway here, we think with the information that we have right now, that medical price impacts for the workers' comp system are likely to be manageable. Now, what do I mean when I say manageable? Think about the scenarios that I just went through, but also what Donna mentioned earlier today. We have better tools, better data, and better information to see these trends changing faster so that we as an industry can react to them more accurately and quicker to preserve the health of the system overall. Now let's head into the last section, interest rates. And this has also been a fun one to watch if anybody out there is into watching financial markets as much as I am. Does anybody want Jerome Powell's job right now? And I'm not just talking about the threat of getting fired about every other day. When I mentioned those two aspects of the economy forecasted to go up at the same time, unemployment rising and core inflation rising at the same time, those two things cause an absolute headache for the Fed and monetary policy makers because their tools can only address one of those issues at a time. If they address the employment side of the equation, the inflation side is likely to get worse. And if they address inflation, as we all learned from history back in the 1980s, the employment side does get worse. Now, if we're thinking about other interest rates out there, if anybody's been following the 10-year Treasury yield, you'll notice it's been doing some very interesting things over the last couple of weeks. And if we are so worried about a recession, why have yields been rising? That's usually not what happens. And then lastly, and this was by special request last year from the audience, we'll take a look at the $36 trillion question. Now, I was hoping when I put this together that there were more zeros in trillion, so hopefully it makes enough of an impact for you guys out there. All right, let's get into it. Looking at Fed funds rate over time, our chart we've had to pull back. First, we went back to the 90s earlier this year because we wanted to compare today to the 1994-1995 soft landing, where the Fed was able to raise interest rates, quell inflation, keep the economy rolling, and extend that cycle for another 5 years before we ultimately had the dot-com bubble burst and had a recession at that time. But now we've had to pull this chart even further back to the 1970s because inflation is once again a question mark for the economy. Now, as we think about the Fed's response to the economy, there was one very important lesson that was learned in 1973. During that recession, which was a rather long and rather deep recession, the Fed prior raised interest rates as inflation was rising rapidly. The economy fell into recession, and the Fed, led at that time by Chair Arthur Burns, lowered interest rates aggressively to support employment. Now, you'll notice coming out of the recession that inflation did come down some, never really got much below 5%, before almost immediately taking off into the end of the decade. Now, Arthur Burns was largely blamed for that inflation running away into the 80s before his predecessor, Paul Volcker, had to famously come in, raise interest rates to near 20%, choke off the economy, put us into the double-dip recession before ultimately winning the battle on inflation at that time. Now, I am not saying today is a corollary to the 70s by any means. There were a lot of differences back then, but again, if we're thinking about those two pieces of the Fed's mandate, rising employment, rising inflation at the same time, some questions have started to arise. Now, Chair Powell has spoken about this phenomenon over the last couple of years, actually quite a few times. And he has talked about that he would rather be remembered in history as Paul Volcker and not Arthur Burns, favoring to fight inflation rather than support unemployment. So if we think about where the Fed might be going with interest rates, we have the dot plot from March. As you all probably know, this is very stale. We'll get a new one in June. But with the Fed on hold, thinking about their next question, are they going to be continuing to lower interest rates over the course of 2025? Or if we start to see inflation peek its ugly head again, the Fed may be on hold or actually even switching to thinking about raising interest rates again. As Powell mentioned, he would rather fight inflation than support employment. Now, the Fed's on hold for now, and we'll get an updated forecast on interest rates coming in June. My guess is it's going to look very different from what we have up here from March. Now let's look at the 10-year Treasury yield, because as I mentioned, some interesting things have been happening here. And as we think about yields and workers' compensation, the Fed funds rate isn't really what we should be looking at for a risk-free rate, because our liabilities, of course, have duration, and we expect to return a gain on those investments over time before those dollars ultimately need to be paid out on claims. Now, as you can see, we started the beginning of the year with interest rates up near 5%. Things moved down to around 4.3% in early March. And then, as you would expect, into and out of the April 2nd reciprocal tariff announcements, interest rates fell quite quickly as worries about the economy rose. But then just a few days after, something interesting happened. The 10-year Treasury yield rose 0.5% in just a few days, the equivalent of more than 2 Fed rate hikes in just those 2 days. And while he won't admit it, I think this is the reason why those tariffs were delayed on April 9th to later in July. Since then, we've had a lot of volatility, but the 10-year Treasury yield has settled in right around 4.3% plus minus. And so when you're thinking about what that means for the upcoming rate-making season, this is actually a very similar rate to where we were at the same time last year. So even though the Fed has cut interest rates by a full percentage point from early last year now into where we sit today, the 10-year Treasury yield is about the same. So don't be thinking about lower interest rates, thinking about interest rates at about the same rate as we think about the implications for the upcoming rate-making season. Now, there is another reason that longer-term yields have remained elevated, and that is the $36 trillion question. Now, this is a fun line because it's parabolic and just continues to go up, but is it actually that scary? Who thinks this number is really scary? Who thinks it's not? Who doesn't know and is not paying attention? Thank you for your honesty. It's really not that scary, though. As we think about it in terms of, as a percentage of GDP, $36 trillion of debt compared to about $30 trillion of nominal GDP that it's against gives us about 120% debt to GDP ratio. Now, that's the highest that we've experienced since World War II, and we've had a rising trend since the early 2000s. However, what is the level that causes concern? Does anybody know? Is it 120? Is it 140? Is it 200? Is it 300? Is it 450? Well, there are other countries out there that have significantly higher debt to GDP levels than we do. Europe, most of those countries between 200 and 300%, and Japan over 400%. We don't actually know what the level of debt to GDP for a developed economy is ultimately a trigger point. But what we do know is that it's the deficits that matter. Now imagine in your own life you have, maybe a mortgage on your house or an auto loan or some credit card debt. Imagine if you weren't actually paying the full amount every month and you were just continuing to accrue more debt every time. Well, that's what the federal government does. Luckily, they don't have a bank that's going to come in and foreclose on them, but the deficit is really what we should be watching. Now, deficits have been volatile since the 2000s, the last time we actually ran a balanced budget and saw deficits declining. But projections from the Congressional Budget Office, again, nonpartisan scorekeepers of Congress, are for deficits to remain stable over the next 10 years. However, these deficit projections are based on the written law of the Tax Cuts and Jobs Act, which is set to expire the personal provisions at the end of this year. Those would raise some revenues and would decrease the deficit, offsetting some increases in spending in other areas. Now, what Congress is attempting to do is use a little bit of budget trickery and say, instead, let's look at the written law of the bill and say, because the rates are as they are, we can extend them with no impact on the deficit at all. Now, that's all well and good. They can do whatever they like on that front, but the dollars in and the dollars out tell the real story. And estimates are that that deficits would increase by somewhere between $3.5 and $4 trillion under an extension of that law without some offsets. So let's think about that offset side. The Department of Government Efficiency has been in the news, and other areas of government spending have been under a microscope and scrutiny. So what does the federal government actually spend its money on? Well, again, we've put this as a percent of GDP terms to show, number one, that federal government spending actually hasn't really increased that much over time compared to the overall economy. And also, as we think about those 4 areas that we highlighted, those are deemed the untouchables. We have healthcare, which includes Medicare and Medicaid. We have Social Security, we have interest on outstanding debt, and we have defense. But even in the all other category, we have things like Veterans Affairs. We have things like supplemental income for needy families and temporary needs. Very difficult things to cut because they impact so many lives in the economy. Now, as we put this slide together, I asked my team to put a little sliver up there on the top right corner for the estimated savings that the Department of Government Efficiency told Congress for the upcoming fiscal year of 2026, about $155 billion. At 0.5% of GDP, that sliver was so small in the chart you couldn't even see it. Again, highlighting the difficulty to actually significantly reform government spending out there. So this is going to be a challenge for the administration as they move forward with their spending bill and some of the policies that they're looking to make changes to at the end of this year. So let's recap. The Fed might be caught between 2 sides of its mandate if those forecasts for higher employment and higher inflation come due at the same time. Despite higher recession risks, yields have been rising because of concerns over inflation, as well as concerns over the national debt and whether some of those longer-term debt obligations will be paid back. And lastly, unsustainable deficits and budget trickery could keep those longer-term yields elevated, even if we were to see lower interest rates from the Fed. And we want to think about those longer-term yields as our discount factor for workers' compensation rather than short-term. So let's summarize the outlook for the state of the economy in 2025. Let's summarize what we talked about today. First, on growth. Economic uncertainty is elevated and recession probabilities are up, though the news that we got over the weekend, I would say, is a net positive for the direction overall. And we might see recession probabilities come down slightly because of that deal with China that was signed for the 90-day reprieve. Consumer spending is going to be key to watch. Where the consumer goes, that's where the economy goes as well. Labor markets are a lagging indicator for the economy overall, but there are some near-term and longer-term risks that we want to keep an eye on for workers' compensation. Not only the risk from a recession, but also the risk to labor supply over the next couple of years. Tariffs will directly impact a small portion of workers' compensation, about 15% of overall medical costs, but will also indirectly impact all of our other medical services over time. The direct impacts based on the information that we have today are likely to be manageable for the system. And lastly, tariffs present a monetary policy challenge for the Fed, where they may be caught between both sides of their mandate. And longer-term yields that we use as a discount factor on our liabilities could stay elevated, despite the recent Fed cuts that we had. So this has been a trip through the economy. I hope everybody was able to take something away and learn something from this experience. A few housekeeping notes before we go on. We're going to be heading into a break, but given the economic uncertainty that we've experienced, now is the best time to get connected. During the break or after, please head over to our Get Connected booth and follow the publications that our team puts out for you, the industry. We publish monthly on the labor market, we publish quarterly on medical inflation, and we publish quarterly on any developments that are of interest on the economy broadly for the industry. Additionally, I'm going to be at the Ask the Experts booth here in just a moment, and some of my colleagues will be there, and I look forward to taking your questions. Thank you, everyone. I'll meet you out there.